In this week's video, we'll study numerous similar periods from stock market history to help us answer the question, are we in the midst of a bullish reversal or are much lower lows ahead? S&P 500 daily, March of 2017 on the left side of your screen. The recent S&P 500 peak, September 20th, 2018 on the right side of your screen. Longer-term clients may remember that we added some new front-end screens in May of last year, and back then we stated we were confident that they would help address some issues and improve performance, and thankfully they did just that. As of September 20th, the model was up 11.76% after fees, measuring performance from point A to point B, and that was after we had a strong finish to 2017. Obviously, since then, we've had what we consider to be a concerning and abnormally large drawdown for the model. So let's talk a little bit about where do we go from here if good things happen going forward, and where do we go from here if bad things happen going forward. S&P 500 daily, December 28th, 2018. Thus far, on a closing basis, the S&P 500 has experienced a 19.78% drawdown, which is very, very similar to three periods that we will cover in this week's video. The max drawdown on a closing basis in 1998, 19.34, 2011, 19.39, and 1990, 19.84. Thus, from a glass half full perspective, it might be helpful to know what happened next in these three instances. After the concerning and large drawdown in the S&P 500, the index rallied between 97.5% and 63.94%. Let's put some numbers around that to better understand what it might mean under the good things happen scenario. In all three cases, if you started out here with $1 million and experienced roughly a 20% drawdown, you would have had roughly $800,000 here, which is very, very similar to the present day if you began with $1 million at the peak. In 1998, the market rallied 65%. The $806,000 at the bottom would have been worth $1.3 million. In the 2011 case, after the rally, 1.5, and hypothetically in 1990, $800,000 from this point here after the big drawdown rallied 63.94%, and it would have been worth $1.3 million hypothetically down the road. Before we go to the next slides, I want to make it abundantly clear the market's present day profile is unquestionably concerning and weak. However, global Dow, December 28th, 2018, bearish breakdown here. It appears that the bounce is coming at a logical level. What once acted as resistance, may now act as support, with the key word being may. That's to be determined. Similar situation, December 28th, NYSE composite weekly. Resistance in this area, a little bit of support, possible support, possible support. S&P 500 daily, December 28th, 2018. Present day rally began, lows 2016, rallied to the high 2018. We came down, closed below the 50% retracement for one day, and then rallied back. That's the potential silver lining in the dark cloud. The bad news would be it looks like the 38.2% retracement thus far is acting as resistance. Given our current allocations are highly defensive, and we can determine that by looking at the percentage exposure to cash, the percentage exposure to bonds relative to the percentage exposure to equities or stocks. Here's our roughly 20% drawdown here In the 1962 case, things got quite a bit worse. Max draw was over 26%. In 1987, which really isn't that great an analogy as far as the plunge goes, the max draw was 33.5%. So if we go back to our hypothetical example, if we started with $1 million here, took a 20% drawdown here, but had scaled out to a very defensive posture, if the market fell to this level here, hypothetically, we should be able to mitigate some of this $66,000 loss between this point here and this point here. And if we had a drawdown that reached the 1987 level, based on our current allocation, we should, with a high degree of certainty, be able to mitigate some of this additional loss in here. So if things get worse from here, the model can absolutely positively add value. And given how weak the present day profile is, it's not out of the question that something on the order of magnitude of a 49 or 50% drop could occur from the recent peak. Once again, based on our current posture and allocation, hypothetically, a 49.15% drawdown from the peak would take $1 million portfolio down to $508,000. Telling us, hypothetically, if we're sitting up here with a conservative allocation at roughly $800K, under this type of scenario, we should be able to hypothetically mitigate this additional $293,000 hit that we would take if we were invested in the S&P 500 in a buy and hold manner. Said another way, while our drawdown is very, very similar and very, very painful in the present day, just as it would be if we were a buy and hold investor, a buy and hold investor has no game plan to mitigate these additional losses from here under the bad things continue to happen scenario. That's not the case for us. We've already taken defensive action, and if we move in this direction, the model will begin to add value very, very quickly. If we experienced something on the order of magnitude of the financial crisis, which for the S&P 500 index, peak to trough on a closing basis, the loss was 56.78%. How much value could the model add between this point here, hypothetically, and this point here? Versus a buy and hold index investor, we should be able to mitigate a very, very high percentage of what would be an additional loss of $369,400 for a buy and hold investor, hypothetically, with no exit strategy. Our performance year to date is just as disappointing, if not more so, than the S&P 500 index. But our risk exposure from here, based on the market's profile, is infinitely better than the market's profile under the bad things continue to happen scenario. How about 1929? While we're not predicting gloom and doom on the order of any magnitude, these are things that have happened in the past. The Dow Jones Industrial Average lost 89.19% on a closing basis from peak to trough in the 1929 to 1932 bear market. Going back to our hypothetical scenario, we started with $1 million, had a 20% drawdown, and we're sitting at roughly $800K in here, and the market dropped in a similar manner here. The model should be able to help us mitigate this additional loss from point A to point B, hypothetically, which would be $693,000 if we started with $1 million at the peak. Let's assume you're not running the model and you have a 20% drawdown here. How well are we going to sleep at night if we have no exit strategy whatsoever and we're a buy and hold investor, and we know that history says we could see additional losses from here, and the total loss could reach anywhere between 26% and roughly 90% in a 1929-like scenario. Again, we're not forecasting gloom and doom here, We're simply making historical references. And this is why at some point you have to draw lines in the sand and start managing risk. In this scenario, if you just kept moving your lines in the sand, you eventually would have lost over 50% of your capital. The market had a big rally after Christmas. Has it proven that much? Not really. You can find this in our Twitter feed, December 20th, well before this big move. Good to understand while screens are red. So we tweeted it in here when things were bad. History tells us stock market corrections, and especially bear markets, can experience sharp, oversold counter-trend rallies. I would say thus far this would classify as a sharp, oversold counter-trend rally. The trend is down. We were oversold here, and this is a sharp rally. We also posted on Short Takes the morning of this gigantic move. Before the really big move started, we hit the publish button at 10:52 a.m. The majority of the gains came probably in the last 2 to 3 hours of the session. From Short Takes, the market's technical profile was weak before the 2018 lows were taken out and has only gotten weaker since these bearish breakdowns. Thus, it is going to take more than an oversold rally to repair the damage. The market may want to come back and retest the 2018 lows. Until proven otherwise, the concept of what once acted as support may now act as resistance. The market may want to come back and retest the 2018 lows. So far, that appears to be what's happening until proven otherwise. Let's try to anticipate some questions here. If the bigger picture says right now this is most likely an oversold counter-trend rally, why would we add a very, very small stake back to the stock market in here? Well, there are several reasons. Reason number one, on Christmas Eve, we've been waiting and waiting and waiting and waiting for the market to prove something to us, to tell us that this plunge from a risk management perspective might be ending. You can see here on Christmas Eve, we do not get it. And it was a little unfortunate that our last level in our scale-out plan was exceeded on Christmas Eve. And many of the levels in that plan were literally derived months or weeks ago. So when we get here at the close, during the day, we're looking for anything to hang our hat on to possibly defer that decision. The market didn't give it to us. I think we closed at the session low on high volume. Been doing this a long time. One of the most dangerous things that you can ever do is break your discipline from a stop loss perspective. So was it a little bit unlucky that the last step out occurred here? I would say yes, but it's not that big a deal. It really doesn't change much for us. There's another reason for stepping out here. When you get down to the end of your equity exposure, since clients are coming in at different times, to scale out of the last bit of the stock allocation, we have all types of different positions, mongrel positions. It's messy. It's not clean. This also afforded us an opportunity to clean that out and get everybody on the same page, which makes things extremely efficient going forward. By Thursday's close, this, from a potential crash perspective, looks better than this here, and we don't like to be one-sided, 100% one-sided in the market. We like to have some exposure to the equity side, even if it's extremely small, some exposure to the conservative side. It helps all of us keep a much more open mind about all outcomes going forward. And you'll see, adding back the very small position, and how much risk are we taking here? Well, here's a good way to answer that. If the position that we took here, if the stock market went to zero and it lost all of its value, what would the percentage loss be for your entire portfolio? The answer is very, very small. We still purposely have an extremely conservative allocation based on the facts in front of us. We don't want to get overly concerned about this big move here. It very well could get 100% retraced in this direction. That falls into the to be determined category. As we've stated previously in the video, in the fourth quarter of this year, we've taken what we consider to be an abnormally large and concerning drawdown. Let's talk a little bit about why that happened and what we can do to address it in the future. Just recapping here, 2018, here's January. We get a 10.16% correction on a closing basis from point A to point B. The model properly classifies basically all of this as volatility to ignore. We did make some chess moves in here, but kept the vast majority of the portfolio intact here, allowing us to hold our positions and see our account balances hit new highs here. Therefore, when the market gets here on October 3rd, 2018, and we begin to see some things to be concerned about, which we did, this is what we knew. We knew that we had several months of potential support below us. What once acted as resistance may now act as support, possible support, possible support. Same thing with this trend line in here. We also knew since World War II, there have been 56 stock market pullbacks, 22 corrections, and 12 bear markets. The model is based on how markets operate in the real world and probabilities. We also knew that since World War II, only in 1 year, 1990, did the market have two 10% plus corrections. Therefore, was it reasonable for the model from a probability perspective to try to treat any pullback here as something that would be relatively shallow, maybe on the order of magnitude of 6 to 9%? Well, looking back to World War II and considering how many years there are between point A and point B, the odds were basically 98.63% that any pullback here would be relatively shallow within the context of an existing bull market. Obviously, that didn't happen. That doesn't mean that we didn't see things to be concerned about up here. But there's always things to be concerned about on any pullback, whether it's 3%, 6%, 9%, or 20%. Therefore, going forward, if 2018 was extremely rare, and rare in a manner that was similar to 1990, and basically only 1990, it might be helpful for us to examine 1990 and see what we can learn and see if there's any way that we can improve. 1990, you get an 11% drawdown early in the year. Market goes on to print a new all-time high. The breakout fails. In this case, I believe we're using the highest high to the lowest low. This was a 20.32% drop. Very, very similar to the drop that we've experienced in the present day. When we review this, several ideas come to mind in terms of trying to minimize the probability of something happening in the future again. And it's a relatively easy fix that really won't impact 99.9% of the cases. There's some easy if-then statements that we can put in related to our whipsaw rules that would allow us to scale out faster in a case like this. You can see in the 1990 case, broke below the box, came back up, retested the bottom of the box, and that failed and eventually went on to print a lower low, which could happen in the present day. And a common theme in this video, remember, this year is similar, shares something with 2018. From the first low here to somewhat of a final bullish breakout, it was a mess for 5 months. and why we shouldn't get overly concerned about the rally off the low this week. In this case, all of it was retraced and the market dropped 9.82% from point AA to point BB, which is one of the reasons why we still have a highly defensive posture till the market can prove something. And one of the reasons why we want to have a mix of cash, stocks, and bonds is after a plunge, it's very, very likely that we're going to have periods where stocks lead for a short period of time, then bonds lead. A little more mixed allocation will allow us to try to cut our trading frequency and see how things play out. Now remember, the drawdown in this case from the high to this low was 20%. If you bailed out here and said, I can't take it anymore, how would that have compared to asking, is there any potential reward coming for patience or enduring these whipsaws or staying disciplined? In this case, from point D, the answer was an emphatic yes. After making one more lower low, it was whipsaw city, but the gain from point D to point E was roughly 64%. And in 2018, bending over backwards in terms of the model to try to treat the decline as volatility to ignore did not add value. But in most cases in the stock market, including these 16 anecdotal cases between point D and point E, that discipline, more often than not, is going to add value for us. Hypothetically, from point D to point E, you could have made 0 trades and made over 60%. At the end of the video, we'll talk a little bit more about improvement ideas going forward. Since the themes are going to be similar, we're going to move very quickly. Tony Dwyer, here's his handle right here on Twitter. You can follow him. There have been 3 20% non-recession stock market swoons since the late 1970s. We're currently experiencing the 4th. Therefore, the current swoon, or 2018, shares something with 1987, 1998, and 2011. Thus, what can we learn? After the gigantic plunge, Black Monday, we got a sharp, oversold counter-trend rally to point A. And for the most part, it was all given back when the market fell 14.66% after that rally from point A to point B. As we've covered on short takes in the past, it is not unusual for markets to consolidate after a plunge. In this case, despite the mess between point A and point B, the move off the low was 27.19%. And now you're beginning to see why we added back some stock exposure. If we're going to get something like this, then we would prefer to have somewhat of a mixed allocation so we can try to ride this out and see which way it breaks. When you get a lot of technical damage, it typically takes time for the market's profile and math to improve. And this question may change your perception of anything that you hear that says the present day is similar to 1987. Question: how many trading days between Black Monday and the lowest intraday low? The answer is 1. Thus, any statistic that you hear about 1987 after Black Monday isn't necessarily bearish from a historical perspective, because the intraday low was made 1 day after Black Monday. You remember earlier in the year, we managed against the low 25.32. It worked extremely well. In this scenario, second half of 2018 Q4, we tried to manage against a low. It didn't work particularly well. More often than not, when you get signs of a low, trying to hold is typically the better strategy. Not always. So here's an example of a stat. Twitter handle here. Present day, the S&P 500 fell more than 1.5% for 4 consecutive days. We're talking about price action as of Thursday this week. And then rallied more than 5.8% over 2 days. Between 1927 and the present, it only happened one other time. Many Twitter users are deleting this after part, and they just say in 1987, implying that it's bearish. Well, you can see here that the similar price action occurred after Black Monday, which means the fact that the present day is similar to this point here tells us a couple of things. One, we should be prepared for another pullback potentially. And if the present day is similar, it could be part of a bottoming process that could take some time. As you can see here, after the 1987 crash, it was whipsaw city, which means we can't be allocating to the data every Friday in here. We'll get whipsawed out of our mind. And even if you were holding a balanced portfolio, there's going to be a lot of volatility and frustration in here. Was there a reward for remaining patient and disciplined and withstanding some ugly trades and whipsaws? In this case, the answer is yes. Eventually, from the low, which is made one day after Black Monday, the S&P 500 rallied a long, long way into the peak in the year 2000. And this helps illustrate the basic point of trying to err on the side of treating all volatility as volatility to ignore until we get clear evidence of what looks like the primary trend rolling over. Again, hypothetically, in this case, you could have made one trade here, 0 trades between point A and point B, and booked a gain of over 600%. Extremely important to note, we're not implying that we wouldn't manage risk between point A and point B with the model. Talking about basic concepts of trying to ride out volatility more often than not. As we've seen in Q4 of this year, it doesn't always work in our favor, but more often than not, it does. Back to Tony's tweet. Similar non-recession market swoons. We just covered 1987. Let's look at 1998 and see what we can learn. You get the big decline here. A sharp oversold counter-trend rally that lasts several weeks, and then a 13.39% drop between point A and point B when we retest the low. Once again, a period of confusion and consolidation after the plunge. In here, if you own some cash, some stocks, and some bonds, it's much, much easier to remain objective about bullish outcomes and bearish outcomes. It's been very, very ugly in the present day. And it would have been very, very easy to throw in the towel here. What type of reward came in this case? And this year is similar to 2018 from the low in October. This is an example where the market rallied strongly off of the low and gained over 65% before peaking in March of 2000. Another example of a basic tenet of the model. Markets are extremely volatile and extremely difficult. Our default posture is to try to treat all of it as volatility to ignore. In this case, hypothetically, you could have entered at point B, made 0 trades between point B and point C, and gained over 65%. We were extremely disciplined in Q4 of this year. It didn't really pay off. More often than not, that type of discipline pays off in spades. Back to Tony's tweet, the third year that's similar to the present day, 2011, what can we learn? Similar situation. We get a low, a sharp counter trend rally off the low, then a decline of over 12% between point A and point B. After a sharp plunge, not uncommon to see consolidation. Market wants to figure out which way to go next. Tons of whipsaws and confusion. Hence the desire to own cash, bonds, and some exposure to stocks until the market tips its hand one way or another. Is there anything else similar between this drop in 2011 and the present day? The answer, yes. Bespoke Investment Group. There have been only 2 other 4-day stretches where the S&P 500's advanced decline line was either above plus 400 or below minus 400. One of them, August 11th, 2011. In this case, that similar price action to the present day was part of a bottoming process that took several weeks in here. This stat helps us keep an open mind despite the market's awful-looking profile of better than expected outcomes. If you threw in the towel here because you were tired of the whipsaws and some short-term bad trades, would that have paid off? Or was it better to try to hang in there and see what would happen after the period of consolidation? In this case, the move from point B, the low in 2011, which was made in October, to the peak in 2015 was over 95%. Once again, once a trend was reestablished, erring on the side of trying to leave things alone and trading less was extremely helpful. It's not always helpful. Hypothetically, you could have made 1 trade here at point B, 0 trades between point B and point C, and booked a gain, a very, very satisfying gain. A very satisfying gain relative to what appeared to be a devastating 20% plus drawdown here. 1962. Why is 1962 similar to 2018? The answer is these 5 candles in 2018. This is Ned Davis Research. You can Google Ned Davis Research to find their website and Twitter feed. Similar price action to the price action that we just experienced in 2018 came during the 1962, 2002, and 2015 bear markets. They classified 2015 as a bear market. I'm guessing they're using highest high to lowest low to get over the 20% threshold. Let's take a look at each period and see what we can learn. So 2018, present day, is very, very similar to 1962. This price action here in 2018 is similar to this price action here in 1962. And this price action in 1962 was the early stages of a bottoming process. We're having somewhat of a mixed allocation, and trying to ride it out and see what happens would have been helpful. But that price action was not the low. After the plunge, we had a sharp oversold counter trend rally, and then the market fell an additional 15% from point A to point B. This was the final low, but taking a very, very measured approach when the model and the math were very, very weak in here would have been helpful. Why? Because from this oversold rally here, almost 5 months later, the S&P 500 was 13.6% below this point here. Hence why on this bounce here, we want to have some exposure to stocks to set us up for something like this, but we do not want to have a big exposure to stocks until the market proves quite a bit more, which it may, but it hasn't yet. It's very, very possible that we're going to have Whipsaw City as the market tries to right itself. How about in this case, after the incredibly frustrating drawdown and whipsaws in here, Was there any reason rationally to hang in there? Or were you rewarded if you decided to stay the course in this case? The gain from the lowest low, point B, to the peak that came years later was over 83%. As we covered last week, there is always another side to these ugly markets. And we're just not arbitrarily picking 1962. This price action here is very, very similar and rare to the rare price action we saw this week. Another example of the basic concepts used in the model. Hypothetically, you could have entered here and treated all of this as volatility to ignore, made 0 trades between point B and point D, and booked a very, very satisfying gain that would have made us forget about all of this pain and the big drawdown here. But that only happens if we keep an open mind and stick with the system. With the benefit of hindsight, this 6-month period here of consolidation, frustration, whipsaws, and confusion didn't really appear all that bad a few years down the road. What happens in 2018 is to be determined. Another year, Ned Davis, 2018 price action, very, very similar to price action in 2002. Here, once again, the similar price action was the early stages of a bottoming process. If you sold out your last stock position right here, it would have felt horrible during this gigantic oversold counter-trend rally. If you missed this rally or were sitting in cash during this entire rally, would it really have hurt you? In this case, no, because almost all of it, if not all of it, was fully retraced. The market dropped 20% from point A to point B. And in this case, from this high here, the market was 18% lower almost 7 months later, telling us that when you come down and get an oversold bounce, it's possible, when we have an extremely weak profile as we have today, that even under a best case scenario, which is a market bottom, we could see frustrating and confusing consolidation action going forward. Having a whipsaw game plan and somewhat of a balanced approach with cash, bonds, and stocks can help us remain objective in here and try to reduce trading frequency. In this case, and this is after a massive drop, we have not had a 50% drop. So the duration of any type of sideways movement, if we're bottoming now, most likely would be less than this. But in this case, 284 days, market moves sideways between point A and point B. Same thing down here. From this low to this point B, 231 calendar days. And just like the plunge in February of 2018, if we're not careful, it's possible we would get whipsawed out of our mind as the market consolidates these losses here and then decides which way it wants to go. Was patience rewarded in this case? From this point here to this point here that occurred several years down the road, the answer is yes, allowing us once again to illustrate the concept of trying to err on the side of holding positions and treating volatility as volatility to ignore. Hypothetically, we could have entered here, made 0 trades for several years, and booked a very, very satisfying gain. Harder markets are often followed by easier and more satisfying markets. Frustrating periods with whipsaws and bad trades are often followed by periods marked by stronger trends, allowing us to reduce trading frequency and move back to more of a we're in this for the longer term investment posture. Ned Davis, 2018 price action, very, very similar to a period in 2015. The lessons are similar. This price action here is very, very similar to the price action in 2018 that we just experienced. This price action in 2015 ended up being part of a bottoming process. If we quote unquote missed the oversold bounce, were we toast in this case? No, the market dropped 7% after the oversold bounce to point B. And if we missed the oversold bounce, the market was eventually 10% lower almost 5 months later. And while we were in this trading range here, having somewhat of a mixed asset allocation, let's see what happens by holding some stocks, some bonds, and some cash game plan, would have made it a little easier to navigate in what is a very, very difficult period. And remember, price action here is similar to the present day. We're not arbitrarily picking this example because it's bullish. In this case, eventually, patience was rewarded when the S&P 500 moved over 50% from the low in February of 2016 to the peak in January of this year. Trying to treat this as volatility to ignore resulted in some drawdowns and frustration in here, but worked extremely well here, hypothetically allowing someone to enter here, make 0 trades between point C and point D, and book a very satisfying gain that easily would have offset a frustrating, and I'm not sure I'm going to continue doing this, drawdown that occurred in this period here. You may have noticed this tweet also mentioned 11/24/2008 was very, very similar to what we've seen in December of 2018. This day here and this price action here that's similar from an AD line perspective to December of 2018 was part of a bottoming process. If we missed the oversold rally here, were we toast? No. The market gave it all back and dropped 29% between point B and point C. But eventually, good things did happen after this point here for a long period of time. As we discussed last week, we need to keep in mind we're in a very, very rare market here, which means things that are concerning at a typical bottom are probably going to be exacerbated in this decline because it's rare. So anytime we have a difficult period, we're going to increase our trading frequency. As we noted way back on October 26th, we've done that. That's uncomfortable. Way back on October 26th, we're going to experience some whipsaws, bad trades. We've done that. I don't like it. It doesn't feel good, but it's part of the process. When you backtest the model, it always feels like it's not working because you experience whipsaws, you have bad trades, but eventually a trend emerges and the math, the odds say, will get us realigned with that trend. Normal markets are difficult and volatile. This is a rare and somewhat abnormal market that makes it more difficult and more volatile. There's always a tendency in the stock market to think that everyone else is knocking the cover off the ball 24/7. As some of our followers note, this is a difficult market for most everyone. And every system and approach, even those that are doing extremely well right now, experience drawdowns in difficult times. No system is running smoothly 100% of the time. That type of system does not exist. Here's an anecdotal example. Is this move here, the gigantic rally that we have with these 2 bars that occurred this week, frustrating for people? Other than us, because it's been frustrating for us. Yes, this tweet was sitting out there for 12 hours. 0 retweets. Some quick stats here that might be helpful LPL research. Going back to World War II, there have been 14 bear markets with 7 of them accompanied by a U.S. economic recession and 7 during economic expansions. The recessionary bear markets were quite painful, with an average decline of 37%. It could get worse. Right now, as far as we know, we're not in a recession. That could change going forward. But 3 of the past 4 non-recessionary bear markets ended at a 19% correction, which is basically the drawdown that we've already taken. And in these cases, the average decline in a non-recessionary bear market, 24%. Again, for the most part, we've already experienced that type of drawdown. If the present day is similar to these historical cases, we could make a lower low, and we should also be open to a bottoming process and some type of reversal. It's in the realm of possibility. Things feel really bad right now, but in the past, in bear markets without recessions, it took the S&P 500 about 11 months to recover the losses. In the last 2 bear markets without recessions, the S&P recovered in 3 months, 1998, and in 5 months, 2011. It feels bad right now, but it's possible that things could improve. It's also possible that they could get much, much worse. From a psychological perspective, markets can be very, very cruel. It is not uncommon during corrections and bear markets and pullbacks to give back years of gains. For example, Global Dow, December 28th, 2018. We draw a horizontal line from where price is today. We can go back, we're basically at the same level 11 years prior. Often periods of difficulty are followed by periods marked by satisfying returns. 2018, still in the to be determined category. You said earlier in the video that we do have several ideas, several things that we want to check out to try to limit the drawdown that we've experienced or mitigated in the future. Therefore, to free up some time, we're going to leverage an industry standard practice, and for an indeterminate amount of time, we're not going to be accepting new clients, which will allow us to focus on our existing clients. Our existing clients have been fantastic during the volatility in the second half of 2018, something that we greatly appreciate. And we feel confident that if we take a little bit of extra time to do some research and do some additional back testing and some tweaking, we can make some incremental improvements to our process, as we always do after difficult periods in the market. We have a very specific list of things that we want to reread, study, and test out. There's always a stressful side to volatile periods, and there's also an exciting and something to look forward side to volatility and difficult periods in the market. And that is, at some point in the future, we know with 100% certainty the market is going to offer an outstanding and low cost basis, lower valuation entry point. Something that we're excited about and looking forward to. We want to do everything we can to give all of us, and that includes our own money that's invested in the model, the highest probability of being successful in the coming days, weeks, months, and years. And like anything in life, if we choose to, we can try to turn a negative or a difficult period into a positive. We should keep in mind that recent tweaks, as recent as May of last year, did pay dividends for us. And while the present day market may not allow us to see immediate improvement as we did here, there are some things that we can be doing and some things that we can look at to improve our probability of success. And while it may not feel that way, we're actually in a very, very good position in the bad things happen scenario right now. The model could start adding value rapidly if the market can't right itself. And if the data starts to improve, things could get quite a bit better. We didn't arbitrarily pick 1962, 1987, 1990, 98, 02, 11, and 2015 to cover in this video. We covered them because the data ties these periods to December of 2018. So let's go back to our original. If we started with $1 million, experienced a 20% drawdown, and had $800,000, and then the market righted itself similar to these periods, hypothetically, $800,000 on average could turn into over $2 million. The median case is probably more meaningful. Still, $800,000 could potentially turn into well over $1 million. And as we covered earlier in the video, it's not unusual for the market to try to rally after a 20% drawdown. We wouldn't say that's the base case because we need to see a lot more. I think it's fair to say, based on what we know today, this is probably the base case, that things get worse and the model adds value by mitigating the damage. But we could have said the same thing at a similar point in 1998, 2011, or 1990, and these periods tell us to keep an open mind about all outcomes. While it may not feel that way, a drawdown is not unusual here. Even under a perfect scenario, we would have experienced a relatively large drawdown here. We would like to mitigate this number a little bit, but drawdowns are normal. We've been through these periods before, and we're confident that once the whipsaws and frustration, which are a normal part of markets and our process, are behind us, whether it's now or much, much later, we're in a position to add value in the bad things happening scenario and the good things happening scenario, as long as we maintain our discipline. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.